Hey everyone, this is Kirk here again at optionalpha.com and welcome back to the video recap. It's been a couple days obviously because we had the long weekend with the holidays and we're on a short expiration week, so that means lots of trades, in particular a lot of closing alerts that you'll start to see this week as we start to close out some of the trades that weren't as profitable as the ones we've closed out all month. So if you remember, a lot of our strategy is we close out a lot of winners during the month, and we have closed out a ton of winners this month. And what we do is that all of our risk-defined trades, we let them go all the way until about right now during expiration week. So most of the strategies that you start to see us roll off during this time period are in this last week of expiration. So they're either really not close to the money, meaning they're very far out of the money, or they're just not even close to being on the dance floor, as we like to call it. So there's no point in rolling a lot of these trades. It's just better off just close it out, reestablish a new position, or look for new trades. So again, the whole idea here is to maximize our winners during the month and let as many of these trades ride all the way through expiration if they need to ride that long, but then close them out before expiration on Thursday, Friday. So I want to go over some of those trading alerts today, as well as the couple trades that we had on Valentine's Day. And I didn't do a video on Valentine's Day, and I apologize for that, but I was out with my beautiful wife that night, so I didn't do a video for you guys. All right, so the one trade that I want to go over first is the Amazon roll. So what we did here on 2/14, which was Valentine's Day on Friday last week, is we rolled down our call side to a 360, 365 call. And what that basically did was converted Amazon into a butterfly. So we've done a lot of adjusting in Amazon and some of the other ones like Google, Chipotle, etc. throughout the month. And what we did here with Amazon is right before expiration, we rolled down our call side. So we took a profit on this side of the trade, the 370, 375 call spread, took a profit on that one and reestablished a new position at 360, 365, taking in a bigger credit of 86 cents. So what does that create a position? What does that new position look like? And this is what we have here today, and this is actually new and updated with today's movement in Amazon. But we have basically this big butterfly in Amazon centered right around 360. So the whole idea with Amazon is that we didn't really expect to make money on this trade. We're just trying to reduce our loss by taking in these extra credits. But it actually turns out that we're very close to being on the dance floor with Amazon with only 2 days left now after today's trading session. There is a good likelihood that Amazon could rally up another couple dollars and we could close this thing out at a very small loss and potentially even a profit. So I'm not hoping for that, but it is still an opportunity. You can see that the market is right about here, this dotted red line on the Thinkorswim platform. So we are very close to turning this thing around and turning it over into a profit. Again, not really hoping that, or not really saying that that's going to happen, but we definitely have that opportunity. All right, the other closing alert that we had back on Valentine's Day was that we bought back a vertical spread on Microsoft for February. That was pretty much a no-brainer. Microsoft, as well as the whole market, has been rallying higher, so we bought back our 36.35 put spread for 4-cent debit. Took in an $18 profit per spread. Again, we had sold originally 5 spreads, so you can do the math in your head. It was a very nice trade that we closed out. All right, so going down, I'm going to scoot this chart down here a little bit so you guys can just take a look at some of the closing alerts that we had here today. On today, we had a lot of closing trades that we are starting to roll off, some at profits, some at losses. The first one we want to go over is LinkedIn. Now, LinkedIn, we have had an iron condor on LinkedIn originally, and what we did is we got rid of the call side of the trade, so the 210, 215 call spread that we had. So that just leaves us short the put spread, which is in the money. So again, that is still in the money, and we're trying to close that one out as well. But we just alleviated this one. Hopefully we get a little bit of a bounce back here in the next day or two with LinkedIn, and we get a chance to close out that position. But at least we took a nice little profit on the call side of the trade. Overall, it's still going to be a losing trade as LinkedIn continued to move lower after earnings. So we closed out the 210, 215 call spread. We're still left with the 205, 200 put spread, which is just in the money. So we'll wait another day or two on that one, but we're going to continue to actively try to close out that position. It may take a little bit to close that out, but that's our goal, is to actively close out that position. Same thing with BlackBerry. So BlackBerry was another one that we had closed out today. We had bought the 9.8 put spread and sold it back to the market for a credit that was already way out of the money, and we just wanted to get a little bit of money left for it. We could have let this thing go all the way to expiration and lost the $8, But since we had originally bought for these verticals, we want to get a little bit of money back for it. And even including commissions, we still took in a nice credit overall. So the whole idea on that one was that it's so far out of the money at this point that's not really realistic that the market's going to fall to that level, at least for BlackBerry, to make this a winning trade. Chipotle is another one that we have a couple positions on. So Chipotle, we closed out as well of the call spread today, trying to close out the put spread as well. And we closed this one out at a loss, 490 as a debit. Remember, the max loss we can take on this is 500, so we closed it out for $10 less than max loss. But that's, again, name of the game here. And as always, we keep our position size small. We can withstand those types of losers any day of any month of any year. So we've closed out a lot of profitable trades. That, unfortunately, wasn't one of the profitable ones. And rather than let this thing go all the way through expiration and start to get exercise, etc., we closed this thing out at a loss. TLT was another one that I've been flirting with the last couple of days. TLT is the bond chart, and the bonds have been very, very active this last month. We had a 107, 106 put spread, and we bought that for 54 cents, so about mid-price of where we expect to buy a lot of our debit vertical spreads. But TLT just really hasn't turned over. In fact, it's continuing to rally today, so rather than let this thing sit from now and through the next couple of days into Thursday, Friday for expiration, where it could actually roll over and become a total loser, and we could lose this 40-cent credit, I figured, you know what, at this point, let's close out the trade, take the $14 loss we have on this per spread, and move on to the next month. Now, we already have a position in TBT, so I didn't want to roll this position, and again, I'll go over that here on the chart. We already had a position that we had entered on TBT, so I didn't want to roll this trade to the next month because we already had a position. Now, typically, if we did not have a position in TBT, this is one of those trades where you might consider rolling to the next month because it is within that strike price range. So we are within that range that it could, kind of make it a full loser or full winner. And you don't want to take that risk right up until expiration. So it's better just to roll it to next month, possibly even pay a very small debit to do that, because originally this was a debit spread. So you might have to pay a small debit to do that, but it might be worth rolling to next month and extending the trade and possibly having a chance to make money then. In our situation, I looked at the whole portfolio and we already had a position in TBT. There's no point in rolling that to next month. Priceline, this is one that I've got a lot of activity on. So Priceline, thankfully, has come down a lot in the premium, even though implied volatility has stayed super high. Priceline still hasn't announced its earnings yet. I think it's coming up at the end of this week. But we had the 11.45, 11.40 put spread, and we sold that back to them, or bought that back at a 25-cent debit today. So took in a $90 profit per spread. Again, we bought back two of the verticals that we had, so a very nice $180 profit on that trade. Again, if you look at Priceline, we could have easily kept this thing all the way through earnings, and you'll notice how erratic Priceline has been trading right up until its earnings. So earnings are coming up in the next couple days, I believe, before expiration. So we didn't want to be faced with an opportunity that it could continue to move lower, even though our strikes are very low. We didn't want to have an opportunity that this price line gaps lower on bad expectations. Sometimes when everyone buys up the stock ahead of earnings, what we actually see is the buy the rumor and sell the news type of event, where everyone buys up the stock ahead of earnings, expecting earnings to be really good. And even if earnings are really good, the stock tends to sell off because everyone already priced in a great earnings move. So this is actually a stock that I'll be looking at to sell some sort of iron condor or strangle coming up in the next couple of days. So be on the lookout on your radar. Because implied volatility is at the 82nd percentile, this is a great opportunity to sell implied volatility regardless of the directional move right at earnings. But we got to time it right. We got to sell it right before earnings happen. We don't want to be stuck with this thing a day or two before earnings. We want to be very neutral in our position in straddling and strangling the market. Alrighty, and the last trade that we had here today was actually a option that expired. The VIX options expired today, so that was a little bit different. So they don't expire on the usual cycle as the regular options. And we had the 21-23 call spread that expired for 0. So we took in a full profit of $36 per spread that we let expire. That was a very easy trade. Again, going back to our massive profit in the VIX that we've had all month. I love when the VIX continues to rally up because we just sell calls and we sell call spreads against it, buy puts. We do everything we can to play that downside move and volatility that we know is going to come. All right, so the last thing I want to go over tonight, usually I'd be over with that, but the last thing I did want to cover with you guys is taking a look at the S&P futures. Now, it's kind of interesting, and it doesn't happen this way on the SPX and the RUT, but if you'll notice, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 days in a row that the market has traded higher. And it's very, very rare to see a massive V-shaped bottom like the market just made. And if you think about it, just at the beginning of this month, we were over here at the highs that we're at now, and everyone thought that the market was setting in new lows and we were going towards a new bearish trajectory. And we very well could be headed towards that direction right now, but it's amazing to see the market cyclicality come all the way back around. And I have to tell you that some people that I have on coaching that have held some call spreads and some put spreads through this trial right here where the market just made a total 180, this is a great example of the market cyclicality working, and it just takes time for the market to do this. Now, this is not a usual move. I don't expect this move all the time, but it's a great example of if you made a trade here that was a 50-50 bet, and even though it became a full loss all the way through the middle part of the month, all the way in the last half of this month, it's turned around and possibly become a profitable trade. So great example of market cyclicality. We just really have no idea where the market goes. I don't know where the market goes. You guys don't know where the market goes. No one expected this type of move. So it's going to be interesting to see what we have coming up for March. I'm definitely a little bit more tilted to the bearish side only because of the number of days we've had the S&P futures close higher. I think we're absolutely due for a couple days of profit taking from the bottom. And I think that we're going to continue to find some resistance up here with people who originally bought back in the latter half of January, early half of February. They originally bought here. So now what they originally thought was going to be loss is now turning out to be net neutral or no profit, no gain. And so we're going to see a lot of selling resistance to get through this. So I do think we're in for a little bit of a downside move. That's the way I'm positioned in my portfolio. But we'll continue to add positions for March and April expiration this week, as well as get rid of everything that we have for February and move on. So as always, I hope you guys enjoy these video updates. Please add your comments and questions below to the video. I'll get back to all of those tonight and tomorrow. Happy trading.